Most people think retirement investing is this endless treadmill. You save, you invest, you sacrifice, you grind, and the finish line just keeps moving further away. 50% of Americans think they'll never be able to retire. Half of people believe retirement is basically a myth. And honestly, I don't blame them. Now look, every finance video online sounds the same. Save more, invest earlier, just max out everything, cut lattes. And none of that actually answers the real question sitting in your gut. When can I stop? When can I stop stressing? When can I stop overworking? When can I stop dumping every spare dollar into investments out of fear? Because here's what most people don't realize. There is an exact point, a mathematical, provable, psychological point where continuing to invest for retirement stops mattering. And almost nobody talks about it. This is where it gets interesting because the answer is not retirement age. It's not a net worth number you saw on Twitter. It's not $1 million or $2 million or whatever your neighbor brags about at a barbecue. The real answer has nothing to do with age and everything to do with momentum. Let me explain. I want you to imagine pushing a massive boulder up a hill. At the bottom, it's brutal. You're straining, slipping, exhausted. Every inch feels impossible. That's early investing. Every dollar you put in feels like it barely moves the needle. But if you push long enough, something changes. You reach a tipping point. The boulder starts to move on its own. Gravity takes over. And suddenly, the effort required from you drops dramatically. Retirement investing works the exact same way. And there is a moment, a very specific moment, where your investments start doing more work than you ever could. That moment is what this video is about. Now, you might be thinking, that sounds nice in theory, but show me the math. Good, let's do that. Let's say you're 35 years old. You've been investing consistently since your mid-20s. You've built up, say, $300,000 in a diversified portfolio. Not insane, not viral Twitter impressive, just solid. Now, assume a long-term average return of 7% after inflation. That's conservative. Stock market has returned closer to 10% before inflation, about 7% after. Vanguard, Fidelity, Morningstar, they all use numbers in this range. 7% on $300,000 is $21,000 per year. Here's the key question. How much are you contributing per year? If you're adding $10,000 a year, your money is already earning more than twice what you're contributing. That's not a motivational quote. That's a shift in power. This is the exact point where the system flips. Your contributions matter less than your existing capital. And psychologically, that's massive. Because up until this point, you're in what I call the effort phase. Your brain associates progress with sacrifice. Every dollar invested feels like a loss today for a vague future benefit. But once your portfolio starts compounding faster than you can feed it, your role changes. You're no longer the engine, you're the guide. Now, here's where people mess this up. Most people never realize they've crossed this line. They keep investing aggressively out of fear, not necessity. They keep working jobs they hate. They delay living. They postpone joy. All because nobody ever told them the boulder is already rolling. Let me show you how extreme this gets. Take two investors. Investor A invests $500 a month from age 25 to age 35. Then they stop completely. Never invest another dollar. Investor B waits until age 35, then invests $500 a month until age 65. Investor A invests for 10 years. Investor B invests for 30 years. Guess who ends up with more money? Investor A. This isn't a trick. This is basic compound growth math. Investor A's money has time. Investor B's money has effort. Time wins. This is why the moment you can stop investing isn't about age. It's about whether your existing capital has enough time and momentum to reach your finish line without you pushing. So let's define that finish line. This is where we need to talk about spending, not saving. Here's what most people don't realize. Retirement isn't about how much money you have. It's about how much money you need. If your annual lifestyle costs $40,000, you don't need a $5 million portfolio. You need enough invested assets to sustainably generate $40,000 per year. Using the 4% rule, which is based on the Trinity study and decades of historical data, that means you need roughly $1 million. Now, is the 4% rule perfect? No. Is it a useful planning tool? Absolutely. So let's say your retirement number is $1 million. Here's the shocking part. You don't need to reach $1 million before you can stop investing. You need to reach the point where your current investments, left alone, will mathematically become $1 million by your target retirement age. That's it. That's the whole secret. Now, look at how freeing that is. If you're 40 years old with $400,000 invested and you plan to retire at 65, you don't need to keep shoveling money into the market if the math already works. At 7% real returns, $400,000 becomes about $2.1 million in 25 years. You've already won. But almost nobody internalizes this because emotionally, it feels irresponsible to stop. This is where psychology destroys people. Humans are terrible at exponential thinking. Our brains evolved to understand linear cause and effect. Put in effort, get result. Compound growth breaks that intuition. So even when the numbers say you're done, your fear says just a little more. And that fear is reinforced by financial media, social comparison, and worst case scenarios blasted across headlines. Now you might be thinking, okay, but what if returns are lower? What if inflation is higher? What if everything goes wrong? That's a fair objection. And this is where margin of safety comes in. Stopping investing doesn't mean stopping awareness. It doesn't mean going all in on spending. It means shifting from accumulation to optimization. Instead of asking, how much more can I invest? You start asking, how do I protect what I've built? This is where diversification, asset allocation, and flexibility matter more than raw savings rate. Here's a real example. I worked with someone who hit their COAST number. That's what this concept is often called, COAST financial independence, at age 38. Their investments, left untouched, would fund retirement at 65. They didn't quit working. They didn't go live on a beach. They switched careers. They took a lower paying job they actually enjoyed. They traveled more. They stopped stressing over every dollar. Their net worth still grew just slower, but their life improved immediately. That's the psychological payoff nobody talks about. Money isn't just future freedom. It's present optionality. And this brings us to the exact point. You can stop investing. It's when three conditions are true. First, your current invested assets, compounding at a conservative real return, will reach your retirement number by your desired retirement age. Second, your lifestyle costs are stable and realistic, not inflated by temporary spending or fantasy expectations. Third, you have enough emotional discipline to not sabotage the plan out of fear or greed. That third one is the hardest because the real enemy isn't bad math, it's anxiety. People keep investing because it feels like control, even when it's unnecessary. Let me say this clearly. There is no medal for dying with the biggest portfolio. If continuing to invest is costing you health, relationships, time, or joy, and the math says you don't need to, you're over-optimizing the wrong variable. Now, does this mean everyone should stop investing the moment they hit this point? No, it means you now have a choice. You can keep investing to retire earlier, you can slow down and enjoy life more. You can redirect money toward experiences, family, or passion projects. You can build a buffer for uncertainty, but the panic stops. And that's the real win. Because once you cross this line, money stops being a source of constant stress and starts being a tool. So here's your action step. Run the numbers. Calculate your annual spending. Multiply it by 25. That's your rough retirement number. Then take your current invested assets and project them forward using a conservative return 6 or 7% after inflation. If the line crosses your number before your planned retirement age, congratulations. You're closer than you think. And if it doesn't, that's okay too. Now you know exactly what you're aiming for. Clarity beats anxiety every time. I'll leave you with this. Retirement isn't an age. It isn't a dollar amount. It's a point where your past discipline buys you future freedom. And once you reach that point, the question isn't, can I stop investing? It's, what kind of life do I want to build now that I don't have to be afraid anymore? That's the conversation that actually matters. And almost nobody is having it.